Welcome back to Orient FX Forex Intensive Bootcamp, Chapter 3 Smart Money Concepts, alright? So today, this first lesson will be on Introduction to Smart Money Concept. It's gonna be a short one, just to share with you guys the overview. It will be more of a narration because this is more of sharing about what are the market makers, what is SMC all about. Alright, so just hang on there with me as we go through. Alright, so in this whole Smart Money Concept bootcamp, we will be going through market makers, what is the market makers about, and also introduction to our smart money concept and their fundamentals, right? Next, we will be talking about our institutional candles, market manipulations, order blocks, liquidity, break of structure and change of characters, and fair value gaps. So I'll be doing this in sequence for you guys, and I'll launch it short videos lesson by lesson so you guys can hear me narrating over it, so it wouldn't be so boring for you guys, right? Alright, okay, these are some lingos that you guys have to take note of as we progress through this bootcamp. So SL is what we call stop loss, BE is break even, TP is take profit, OB is order block, LQ is liquidity sweep. So FVG is your fair value gap, BOS is break of structure, CHOCH is your change of character, and MM is what we call the market makers. Alright, so now diving into the market makers. So what is SMC all about, right? It's more of what it's talking about market makers such as your banks, your institutions, your hedge funds. So these are people with big money, right? They are the one who manipulates the market, trapping retail trader like us. So this whole smart money concept is built upon this, right? About how retail traders are getting manipulated by your big money, right? Okay, so now what is SMC all about? SMC is about learning how to trade like the market makers. So if we can't win them, we learn how to trade like them, because they control 95% of the market with their huge amount of funds. However, we retail traders only controls about less than 5% of the market. So there's no way we can fight them, right? So the only way to win them is to follow them and learn how to trade like them. And this is what SMC is all about. So let's go through some fundamentals before we get started. Very simple, for a transactional market to work, we have to have a buyer and a seller. Be it your supermarket, right? You want to buy an apple at $5, you need someone to sell you an apple at $5. Same thing for a stock market. If you want to buy a stock at $100, you need to have a seller that's readily available on the market to sell you at $100. Same thing for Forex, right? You want to buy gold or you want to buy Euro USD at a certain price, you need to have a seller or buyer that is ready at that price to accept the transaction. Right? So similarly, if whatever you're trading, be it your transactional market, your supermarket, stock market, forex market, it's all the same thing. For a buyer, you need to have a seller that is readily available. For a seller, you need to have a buyer readily available to accept your transaction at that exact price. Alright, so this is what you guys have to keep in mind throughout this entire bootcamp. Alright? Okay. So let's talk a little bit more about institutional candles and market manipulations. So candlestick that forms when institutions manipulate the price to their advantage. This is what we call an institutional candles. So usually these institutional candles are what we call breakout candles. Are usually those candles with like 200 plus pips with little to no rejections. Okay, so usually it will close as a full engulfing candle indicating strong buying or selling pressure. Or it could also be the candle before a big trend reversal, right? This is because institutions like to create a fake out to take out your early buyers and sellers stop loss to fill their manipulation or their main orders, right? Before injecting their main capital to counter trade. Okay, let me give you guys a real life example and what I meant by that. Okay, so when you're looking for institutional candles, time frame does not really matter because you want to catch those candles that have big movement or impulse movement in a case, right? So you guys can take a look at our variant 1 here. We have a continuation breakout candle, right? So prices are in the uptrend and then suddenly we have a big pump, more than 200 pips with an engulfing closure. So what is an engulfing closure? You want to look at the wicks here, right? You don't want to see that it has been rejected a lot like this. This is not an engulfing, right? Engulfing is little to no rejections at the top, right? You can see that there's very, very little selling pressure here. And prices close almost full engulfing at this price. So this is what we call an institutional candle. Okay, so now let's look at variant 2. This is also an institutional candle. Why is that so? So number 1, we can look at institutions manipulating the price. So what institutions like to do is they tend to push the price by artificially inflating their orders, right? Push all the way up to take out all early seller stop loss. And then when the early seller stop loss get hit, what happens? It creates a pool of buy liquidity, buy orders. Why is that so? Because when your seller stop loss gets taken out, what happens is they're forced to buy back the sell orders that they place in, right? So this creates buy orders for the big money. So when the buy orders are finally there, they can finally fill their sell orders. Remember what we talked about earlier? When you want to sell something, or you want to sell, let's say for gold in this case, right? You need to have a buyer that's readily available in the market. However, at these prices here, there's not enough buyers to fill the orders of these institutional investors or hedge funds or your big money or your banks, right? So what they do is they artificially inflate the price to push all the way up, creating this liquidity sweep. So this whole liquidity sweep area is where your early seller stop loss get taken out. So when their stop loss get taken out, they are forced to buy back their positions at a loss, right? So when they are forced to buy back their positions at a loss, this creates a pool of buy liquidity, buy orders, right? And this will allow your institutions to finally be able to fill their sell orders before we have a perfect downtrend after that. So this is what we call a manipulation of your institutional candle, right? Okay, next. So let me explain a little bit more and in depth here with, it's basically what I talked before, but now I will explain even more in depth for you guys, okay? So when the institution wants when the institutions wants to open a large buy or sell order, they need counterparties to execute the transaction. So when they want to sell, they need buyers, right? When they want to buy, they need to have sellers. So basically, they usually see a support or resistance level on the chart and assumes that plenty of stop losses are concentrated just beyond this level. So as retail traders, remember, you guys tend to plot your support and resistance level, right? And most of the time, especially when starting out, even for me when I was starting out, usually this support and resistance level gets taken out and your stop loss gets hit, right? Even though you're trading with your support and resistance. So why is that so? Because if the institutions want to have a long position, right, they want to buy and hold. They don't just want to scalp 20-30 pips like us, right? They want to hold thousands of pips of at least 500 to thousands of pips of take profit levels, right? So what they have to do is they will first sell to push the price below the support so that they can be able to create liquidity to fill their orders so that they can buy at a discount. So institutions doesn't want to buy when prices are sky high because they won't be able to profit. So what they want to do is to manipulate price to take out your stop losses, and they will be able to enter at a discounted price, right? So this manipulation will trigger all the stop losses located below the support level. So because of these stop losses were placed by traders who had bought previously, they are essentially sell orders. Why is that so? So early buyers, when their stop loss get hit, what happened? They are forced to sell off their positions at a loss, creating a pool of sell orders, right? Like what I said before, when your buy orders get hit with a stop loss, you are forced to sell off your buy positions at a loss. Same thing for your sell orders, right? If you hit stop loss on your sell orders, you are forced to buy back your sell positions at a loss, okay? So what happens? So this is why usually you'll see a big pump when sell order stops get hit and a big dump when buy order stops gets taken out. Okay, now next, I'll show you a perfect example of market manipulation which we just talked before, but now with more context, okay? So let's all start from this order block here, right? So order block. After order block is the candle before an impulse movement. So this is an institutional candle that what the banks did. They injected huge liquidity, creating a 400 pips engulfing candle with little to no rejection. So 400 pips in one singular candle is pretty crazy, right? And then after that, what happens is we have another order block created here. We can ignore this for now as we'll talk about order block in our next lesson. But now what is more important is you can see that prices actually pushed all the way up. And this is where people started to sell, right? So we have a group of sellers here, as you can see from this little rejection here. So this is where sellers are stepping in. But what happened is prices created this fake out and then manipulated and pushed all the way up. And even higher here to take out all of these early sellers stop loss at these areas here. So another institutional candle after manipulating a fake out to get their main orders filled. So this is where they actually want to inject their sell orders or get their sell orders filled at a premium. So discount is basically buying at a cheaper price and premium is selling at the best higher price possible. And then after that, what you see is actually a full liquidity sweep. So this means that institutions has finally injected their sell orders, and their sell orders has been filled with your early seller stop loss, creating a pool of buy liquidity, buy orders. Alright, and then after that you can see that prices actually continued down, rejected the order block, and then we had a big move clearing all the way, even breaking below this previous order block created. This means that your banks and institutions, your big money has finally entered the market, showing you that manipulation has occurred. Alright, so this is basically what we have for lesson 1. Very simple introduction to what is manipulation and how manipulation occurs, and this is a very crucial part of our fundamentals inside our SMC concept. Alright, catch you guys on lesson 2 for order blocks.